I need to ask you something, and I want you to answer it honestly, not to me, but to yourself. How many times have you entered a trade that felt right, felt certain, felt inevitable only to watch it move against you the moment you committed? How many times have you sold in frustration, only to see the stock turn and run without you? How many times have you wondered whether someone, somewhere, knew something you did not? I am here to tell you, they did. And I am going to confess something that took me years and several fortunes to fully accept. For the longest time, I believed I was losing because of bad luck, because of bad timing, because the market was fickle and cruel and unpredictable. I was wrong. I was losing because I did not understand who I was actually trading against. I did not understand that by the time I saw the move, by the time the setup looked obvious and the momentum felt undeniable, I was not catching an opportunity. I was being handed someone else's exit. That confession cost me everything before it saved me, and I am giving it to you now so you do not have to pay the same price. The market does not move randomly. I want you to erase that notion from your mind completely. Every significant move, every genuine trend begins with accumulation. It begins quietly, invisibly, and it begins before anyone in the crowd has the faintest idea that something is happening. The large operators, the institutions, the funds, the syndicates, they cannot simply buy 1,000,000 shares of a stock without pushing the price against themselves. So they are careful. They are methodical. They buy weakness. They buy dips. They buy when others are frightened, and they buy when the news is bad, and they buy when the volume is thin and nobody is paying attention. I watched this happen across decades. I saw it in cotton. I saw it in wheat. I saw it in the railroads. I saw it in the greatest bull markets America has ever known. The pattern was always the same. Before any great advance, there is a period of quiet, a period of sideways movement that bores the public into looking elsewhere. That is not an accident. The sideways movement is the accumulation. The boredom is intentional. They want you looking elsewhere. They need your shares. And then, when they have gathered enough, when the position is large enough, when the supply of available shares has been soaked up, the price begins to move, and it does not move gently. It moves with conviction. It breaks out. It runs. And suddenly, the crowd notices. The crowd piles in. The crowd brings more buyers. And who is selling into that buying? The same hands that spent weeks quietly accumulating in the dark. The same smart money that loaded up while you were bored, while you were distracted, while you were convinced nothing was happening. This is not conspiracy. This is mechanics. This is simply how the game is played. Now, I want you to think about what this means for you. Because if you do not understand this cycle accumulation, markup, distribution, decline, you will be on the wrong side of it every single time. You will buy the breakout just as the smart money is selling. You will sell the breakdown just as the smart money is buying. You will be the fuel for their profits. And you will blame the market for being rigged, when the truth is far simpler. You simply did not understand the rules. I spent years getting destroyed by this very cycle before I began to truly see it, before I began to read what the tape was actually telling me, rather than what I wanted it to say. The tape is never wrong. The interpretation can be wrong. Your emotions will make it wrong. Your ego will make it wrong. But the tape itself, the raw record of price and volume and time that tells the truth, if you know how to listen. In our video, The Art of the Entry, reading candlesticks like a professional trader, we showed you the mechanics of how price forms decisions on the chart, how a single candle can tell you whether buyers or sellers won the session, and what that means for what comes next. If you have not watched that video yet, I strongly urge you to pause and watch it now. What I am telling you today will land even harder once you understand how to read the moment of entry. Because the smart money leaves fingerprints. They leave them in volume. They leave them in price action. They leave them in the way candles form and close and reject and confirm. And once you know what those fingerprints look like, you will never be blind again. But we are getting ahead of ourselves. First, let me show you what smart money accumulation actually looks like and how to spot it before the crowd ever arrives. There is a phase in every great market move that I call the quiet zone. It does not look dramatic. It does not make headlines. On most charts, it looks like nothing, just a stock oscillating in a narrow range, going nowhere, doing nothing. The average trader glances at it and moves on. There is no excitement there. No story, no catalyst, no momentum. And that is precisely why the smart money loves it. Let me describe what is actually happening beneath the surface during this phase. When institutions want to build a major position, they face a problem that you and I do not have at our scale. If a fund wants to buy 10 million shares of a company, they cannot simply place one order. The market would see it. The price would run against them before they even got half their position filled. So they work over time. They work in layers. They use quiet sessions, thin volume, periods when retail traders are asleep or distracted. They buy on the days when the stock dips. They absorb the selling of the impatient. They soak up every share that a nervous hand is willing to surrender. And here is the key insight. They are not just buying, they are testing. Every now and then, they push the price up slightly, not enough to trigger a real breakout, just enough to shake out the shorts. Just enough to see how much resistance sits overhead. If the selling comes in heavy on that little push, they know supply is still too great. They back off. They wait. They continue to accumulate at lower prices. But if that little push holds, if the price stays elevated and the selling is thin, they know something important. They know supply is drying up. And that is when the real move is close. This is what volume tells you, if you know how to read it. High volume on down days during a supposed accumulation phase is a warning sign distribution may be happening, not accumulation. But low volume on down days, that is healthy. That means the selling is exhausted. The weak hands are already out. What is left is held by strong hands who are not shaking out. And when you see this pattern, range-bound price, declining volume on dips, subtle tests of resistance, you are watching accumulation in real time. I discovered through hard experience that the best trades I ever made were not the ones I entered on excitement. They were the ones I entered on patience. I waited for the pattern to form completely. I waited for the moment when the stock told me, not hoped, not suggested, but told me clearly that the balance of power had shifted from sellers to buyers, and then I acted decisively. There is a concept I want to introduce here, one that most people intuitively understand, but consistently fail to apply: the pivot point. A pivot is the moment when a stock has been in a defined range, and it breaks out of that range with authority, with volume, with follow-through, with confirmation. That is the moment the smart money wants the crowd to see the move, not before, after they are already positioned, after they have already absorbed the supply. The pivot is the invitation. And by that point, the smart money is no longer primarily buying. They are holding and waiting for the crowd's buying to give them a price at which to distribute. This is why chasing breakouts blindly is so dangerous. Not every breakout is a real breakout. Some are manufactured, designed to attract buyers into a position that was never going to last. You need context. You need to understand what happened before the breakout. Was there a proper base? Was there true accumulation, or just a brief pause before more selling? Did volume contract during the base and expand on the breakout? These are the questions I taught myself to ask before I ever placed a trade. These are the questions that separate the speculator who survives from the one who does not. In our video, How to Align with the Market and Let Profit Find You, we discuss the importance of not fighting the tape, of getting in harmony with what the market is already doing rather than trying to predict what it should do. I encourage you to watch that alongside this one. Because what we are talking about right now is the highest form of market alignment, understanding who is truly in control and positioning yourself on their side before the move becomes obvious to everyone else. Let me also say this clearly, because it matters. Smart money does not always win immediately. Markets are complex. There are false starts. There are periods where even the strongest hands get it wrong, or where unexpected events disrupt a carefully laid plan. But over time, over the arc of a real market cycle, the pattern holds. Accumulation precedes advance. Distribution precedes decline. And the trader who understands this cycle, who can identify where in the cycle a given stock currently sits, has an enormous edge over the trader who is simply reacting to headlines. Volume is the lie detector of the market. Price can be manipulated in the short term. Volume is harder to fake. When price rises on heavy volume, the advance has fuel. When price rises on light volume, be suspicious. When price falls on heavy volume, there is real selling pressure beneath. When price falls on light volume after a long advance, the sellers are running out of ammunition. Read the volume. It will tell you more truth than any analyst ever will. And I want to be honest with you, because honesty is the only currency worth having in this business. Most people will read what I am telling you, nod their heads, and then go right back to trading on emotion. They will see a stock they like and buy it because they like it. They will sell a position because they are frightened, not because the chart told them to. They will miss the accumulation phase and then chase the breakout at the top, not because they lack intelligence, but because they lack discipline. Because understanding a concept and executing that concept under pressure are two completely different things. That is why we have created tools beyond these videos. Tools designed to help you build the psychological foundation that makes good trading possible. We will talk about those at the end of this video, and I want you to pay close attention, because what you learn here means nothing if you cannot hold it together when the market tests your resolve. And it will test you. It always does. If this is already making sense to you, hit that like button. It helps more people find this knowledge. And drop a comment below. Tell us what you see differently after watching this. Let me tell you what happens after accumulation is complete, after the smart money has built its position, after the supply has been absorbed, after the pivot has formed and the breakout has occurred. Because this is where most traders finally pay attention. And this is where most traders get hurt the worst. The markup phase begins, price rises, volume surges, news starts to turn positive, analysts begin raising targets, social media lights up, friends start asking about the stock. And slowly, inevitably, the crowd floods in. Retail money arrives late to the party, as it almost always does. And every day the price goes higher, the confidence of the latecomers grows. They feel vindicated, they feel smart, they add to their positions. They tell their friends. The euphoria builds. Meanwhile, the hands that accumulated at the bottom are doing something quiet and methodical. Something the crowd cannot see or refuses to acknowledge, because acknowledging it would require confronting an uncomfortable truth. The smart money is selling. Not all at once again. They have the same problem in reverse. They cannot dump millions of shares without crushing their own price, so they sell into the buying. They distribute their shares gradually, over days, over weeks, sometimes over months. Every time a new wave of retail buyers pushes the price up, the institutions use that liquidity to exit. This is distribution. It is the mirror image of accumulation. And just like accumulation, it often looks like nothing on the surface. The price may continue to rise, or it may chop sideways near the highs. Volume may be high, which the crowd interprets as strength when in fact it represents the enormous transfer of shares from strong hands to weak ones. The headlines are still positive. The sentiment is still bullish. And yet, underneath it all, the structure is crumbling. The foundation has been sold out from under the building. Then comes the decline. Sometimes it is sudden, a catalyst, a shock, a piece of news that cracks the surface and reveals what was already hollow beneath it. Other times it is gradual, a slow bleed that convinces itself it is just a pullback, just a dip, just an opportunity to buy more. And the crowd, the late arriving crowd, averaging down into a position that was built on sand, loses not just the profits they never really had, but the capital they started with. I have seen this happen more times than I care to count. I lived through it. I contributed to it on some of my worst days. And I want to be very direct with you. The reason most people lose money in markets is not because the markets are rigged. It is because they are consistently on the wrong side of this cycle. They are buying what the smart money is selling. They are selling what the smart money is buying. And they are doing it because they are following emotion, following the crowd, following the noise, rather than reading the signal. In our video, The Signs You're Finally Becoming a Profitable Trader, we talked about the shift that happens inside a trader's mind when they stop chasing and start observing, when they start respecting the market rather than fighting it. If you have not seen that video, the link is below, and I encourage you to watch it immediately after this one. Because the technical knowledge I'm giving you today is only half the battle. The other half is the battle inside you, the one between patience and panic, between discipline and desire, between the trader you want to be and the habits that are holding you back. Here is what I want you to take from everything I have shared today. The market is not your enemy. The market is indifferent. It does not know your name. It does not care how long you have been trading, how smart you are, how much you need the money, or how certain you feel about a position. The market is simply the aggregate of millions of decisions, and nested within those decisions are the large, deliberate, patient moves of those with the most information and the most capital. Your job, the only job that matters, is to read those moves, to recognize the phases, to enter when the smart money is still accumulating, not when the crowd has already arrived. To exit before the distribution becomes obvious, to think in cycles rather than in moments. This requires something that very few people are willing to do. It requires sitting still. It requires watching and waiting without acting. It requires the discipline to let a setup develop fully before you commit capital. It requires the ego to admit when you are wrong and exit without revenge trading. And it requires the patience to hold a position that is working without snatching at small profits before the real move has run its course. None of this is natural. All of it is learned. And the learning happens not just through watching videos or reading books. It happens through the crucible of real trading, real decisions, real losses, and real wins. It happens through the slow, painful, beautiful process of developing a relationship with your own mind, understanding how it deceives you, how it amplifies fear and greed at exactly the wrong moments, how it invents certainty where none exists. That is why I want to tell you about two resources we have created not as afterthoughts, but as essential companions to everything you have heard today. The first is our ebook, Thinking Like Jesse Livermore, Mastering the Market with Discipline, Patience, and Risk. This is not a collection of trading tips. It is a deep dive into the mental architecture that makes great trading possible, the principles I forged across decades of wins and devastating losses, organized for the modern trader who is serious about this craft. It will challenge the way you think about money, about markets, and about yourself. The link is in the description below. The second is the Livermore Journal, a 9-0 day trading psychology workbook. Because reading about discipline is not the same as building it. This workbook is a daily practice, a 9-0 day commitment to examining your own trading psychology, tracking your decision-making, identifying your patterns, and replacing destructive habits with deliberate ones. If you want to trade like a professional, you must think like a professional, and this workbook is the tool that bridges the gap between intention and execution. The link is also below. I want to close by saying something that I mean with the full weight of everything I have experienced. You already have more than enough intelligence to be a great trader. You do not need another indicator. You do not need a hot tip. You do not need to know what the Federal Reserve will say next week or which sector is about to rotate. What you need is the patience to see clearly, the courage to act on what you see, and the discipline to protect yourself when you are wrong. The smart money is not smarter than you. They are simply more patient, more disciplined, and more honest with themselves about what the market is actually saying. Develop those qualities, truly develop them, not as a concept, but as a daily practice, and the market will open itself to you in ways you cannot yet imagine. The moves were always there. The signals were always there. The only thing that changes is whether you have the eyes to see them.